What's up, guys? It's me here. So most people think that having money is all about investing in stocks like Tesla, Bitcoin or GameStop while watching YouTube videos from financial gurus who guarantee you 60% returns if you just buy their course. But here is the thing. If you want to make real wealth and protect your portfolio during any type of economic downturn, there are actually some very simple strategies that the ultra-rich have been using for decades to build generational wealth. And even though it might feel counterintuitive, now could be one of the best times ever to start investing, because throughout the last 135 years, every single time the market has crashed, there has always been a bigger rebound right after. That means even though timing the market is impossible, statistically speaking, buying consistently is one of the best ways to see positive returns, and when done correctly, there are several steps that you could take right now to ensure you come out ahead when everything recovers. So with that said, let's break down the best ways the rich build a recession-proof investment portfolio. Although before we start, if you appreciate all the unbiased research that goes into making a video like this, it would mean a lot to me if you hit the like button or subscribed. Doing that helps me out tremendously and keeps me motivated to make more of these videos for you. So thank you guys so much. Alright, so first you need to understand how recessions work. Since the 1940s, the US economy has had a tendency to fluctuate between two different types of cycles. The first is what's called a normal cyclical downturn. This happens about every 7 to 10 years when consumer demand begins to slow, unemployment rises, inflation falls, and as a result, the Federal Reserve steps in to save the day by lowering interest rates and printing more money. The second type of recession occurs roughly every 15 to 20 years, and that is due to something called a rolling crisis. This is where a series of unfortunate events happen one after another, like a housing bubble, banking crisis, oil crash, and government shutdown, all of which feed into one another, creating an even bigger disaster that requires a larger solution. In a way, you could think of it like a normal cyclical downturn is like the calm before the storm, whereas a rolling crisis is exactly what it sounds like. Now, as far as which category we fall into, well, unfortunately, history suggests that we could be experiencing the worst of both worlds. On one side, we have a once-in-a-lifetime global pandemic that forced the entire world into a lockdown and caused tremendous financial stress to anyone who was invested in the stock market. At the same time, we also have a record amount of stimulus that was printed within a matter of weeks, a surplus of new spending, supply chain shortages, and the highest inflation that we have seen since 1982. All of this occurring at the exact same time means that we are seeing a perfect mixture of circumstances that makes it nearly impossible to predict how anything will perform. However, despite all of the uncertainty, there are several ways that the ultra-rich have historically navigated through a recession and built generational wealth. First, you have to diversify your portfolio across multiple asset classes. Now, normally, a well-balanced portfolio consists of stocks, bonds, and real estate, but if you want to get fancy, you could throw in things like commodities, collectibles, and alternative investments like cryptocurrency. Of course, not all investments are created equally, and each one comes with their own risk, reward, and expected rate of return. Typically, the safer the investment, the lower the potential return. And the higher the risk, the higher the potential return, so you have to decide how comfortable you are with each one. For example, throughout the last 20 years, the S&P 500 has generated an average annual return of 7.0%. Bonds, on the other hand, have returned around 5.0%. Cash is averaging 0.5%, and cryptocurrency as well, however much you want to admit. However, even though past performance doesn't guarantee future results, it is still helpful to look at how various asset classes have held up throughout every major market downturn. And what's really interesting is that during the worst of the worst, stocks only produced an average loss of 33%, while bonds actually increased 9%. That's because the more balanced your portfolio is across different asset classes, the less volatile your overall returns will be. Second, diversify your investments within each asset class. Now, anytime someone says don't put all of your eggs in one basket, it is important to diversify your investments across different industries, because if something were to happen to one company, you wouldn't be completely ruined. Like, imagine if you only had Apple stock and it dropped 90%, you probably wouldn't be too happy. Or imagine if you only invested in real estate and interest rates went up 10%, that would probably make you want to cry. The point is that the goal should be to spread out your money as evenly as possible throughout a wide range of companies, countries and assets, because then your risk is lowered and you don't have to worry as much about the ups and downs of the market. Third, dollar cost average. Now, I know I just spent the last year telling you why dollar cost averaging does not work, and even though that's true, it's not always a bad thing. See, the idea is that instead of investing all of your money upfront, you break it up into smaller chunks and invest it over a period of time. The benefit of this is that you buy more shares when prices are low and fewer shares when prices are high. And on average, you end up buying at a discounted price. Although the problem with this is that you could end up buying high right before a crash and then miss out on the recovery. Even worse, if you're investing in a declining market, you'll continue to buy higher and higher prices until eventually you are left with a portfolio that's underwater. So how do we fix this? Well, simply put, you could look at dollar cost averaging as a strategy to reduce your overall risk, but only if you do it correctly. For example, since you can't time the market, a better approach would be to invest a fixed amount of money each month without fail. Then within that, include a mix of growth and value stocks. Growth stocks have the potential to multiply your money by several times if they grow faster than the market, while value stocks tend to be more stable and pay dividends regardless of what happens. Fourth, focus on cash flow. I know it is kind of funny when people say cash is trash or cash is king, but in reality, it all depends on the situation. During a recession, the mindset shifts away from investing as much as possible to conserving as much as possible, because no one really knows what is gonna happen. So holding on to cash provides you with the ability to buy in at a lower price, pay off debt, make new investments, or seize a new opportunity. That is why it is not a bad idea to keep 3 to 6 months worth of your expenses in an emergency fund. Just make sure you have a high-yield savings account so it doesn't lose value sitting in the bank. Fifth, don't panic. Now, I know this is easier said than done, but one of the biggest mistakes you could make as an investor is to sell off your holdings at a loss because you watched CNBC for one too many times. Don't get me wrong, panicking is totally fine when the stock market is heading to the moon, but when everything starts falling, consider that this is part of the process, and every single drop has been followed by a recovery. If you really want to build wealth, you have to stick to your plan, stay the course, and keep buying in consistently. And sixth, use a tax advantage account. This one is particularly important if you live in the United States and you haven't already taken advantage of this. See, in addition to having a traditional brokerage account, you also have access to a retirement account like a Roth IRA or 401k, and those offer some pretty unique benefits. First, you get to reduce your taxable income. Second, your investments are sheltered from the IRS. And third, your gains are tax-free once you reach the age of 59.5. That means you could potentially make a 10% return in a taxable account and only keep 16% of the profit, or you could make the exact same 10% return inside a tax-advantaged account and keep all of the profit. Obviously, it's a no-brainer which one you'd rather do. So in terms of what the rich are doing right now, no one really knows. But it is rumored that billionaires like Ray Dalio have been moving away from U.S. Treasuries and shifting towards cash. Others like Mark Cuban believe that cryptocurrencies like Bitcoin are a great store of value during times of uncertainty. While it is also reported that the wealthiest investors are taking profits on their most vulnerable positions and adding to companies that they believe will recover quicker than others. Personally, my plan remains unchanged. I am continuing to invest in a wide range of companies across different asset classes as I normally would, and hopefully in Irish years, we'll look back on this time as nothing but a minor speed bump on the road to recovery. So with that said, you guys, thank you so much for watching. As always, feel free to add me on social media. Enjoy. Thank you so much for watching, and until next time.